Back in the 1990s, when we talked about geopolitical risk, that risk had a true meaning to it. The meaning was disruption of supply in a very, very skinny supply market. If there was a mosquito that passed gas, they had to calculate what that would do to supply and demand. That is how sensitive the market was back in the 1990s. We didn't have really the internet. We didn't have thousands of different methods of tracking supply, demand, logistics, vessels, pipelines, capacity, like we have today. Here we are on a Tuesday watching a Apache helicopter get shot down in the Strait of Hormuz. Here we have Israel continuing to go back and forth with Hamas, yet oil prices are down to $87, $88 a barrel. So the question is, what's causing what would be normal reaction to that kind of geopolitical risk in the Middle East that normally would drive oil prices up $25 to $50 a barrel? Instead, we see $5 to $7 a barrel reduction since last Wednesday or Thursday. Well, let me give you a couple reasons why. In today's world, the trading platforms, those that are trading contracts and barrels, going long and short in that particular commodity, really dominate the market. When you start looking at paper barrels versus physical barrels, there's a big difference. No different than going short on a particular stock. If you have enough short players driving a stock down so they can benefit, you can almost drive a public company into bankruptcy. It's been done before. When you look at commodity prices, you start having traders who've taken really, really long positions on the price and value of crude oil when the Iranian war started. They took long positions expecting oil to go to 90, 95, 110. As the war escalated, as President Trump continued to make veiled threats and then proceeded to push the deadlines for those threats back and back and back, it looked as if, from a speculator's perspective, this is not going to escalate. This is not necessarily over, but we think it's at least contained from a risk analysis. We kind of see what's the worst case scenario? What's the best case scenario? Well, the best case scenario is that the Iranian regime says, we call uncle, we're out, we won't enrich the uranium, we'll tell you what we have is located, we'll stop sending drones, we'll create a centralized, agreed upon administration or legacy or whoever's in charge of the country, whatever you want to call that. And at the end of the day, you have an agreement between the faction in Iran who represents the country and the terrorist agreeing to whatever President Trump's terms are, and there's a stand down. The Strait of Hormuz opens up again, and now we can calculate the amount of disruption in supply that's resulted over the last 90 plus days and what that looks like in terms of meeting and replacing that supply over a period of time and how that affects the fundamental value of a barrel of oil. That's in a perfect world. In the world we live today, we now have a logistical nightmare, repositioning of oil and gas and LNG all over the globe. A geopolitical threat isn't the same threat it was 25, 30 years ago. Today, it's a managed geopolitical threat. How much? Who's causing the threat? What's causing the supply disruption? Can it be replaced or substituted for other sources around the globe? And what that looks like in terms of trading value and what I call the true point of sale value. So there's a difference. Traders are speculating what it costs to move oil around today. And then they have derivatives out there saying what they think it's going to be like in 20, 30, 40, 60 days. At the end of the day, there is a value paid at the wellhead. That wellhead is getting either a price for Brent, North Sea, Louisiana Sweet, West Texas Intermediate, depending on the market, depending on the geographical location. Crude oil brings a different price all over the world. But it goes back to a normalized value as you look for competition between supply and consumer. Today, that consumer is saying we're going to pay $88 a barrel relative to what the traders have placed on today's physical barrels. How quickly can that change? It can change $10 to $40 a barrel overnight, one way or the other. Maybe it goes down another 10, maybe it goes up another 10. Maybe, in fact, the traders who are desperately trying to get out of their long positions, expecting that the war would have lasted longer, that President Trump would have gotten tired of being patient with a so-called agreement, or realize the agreement's not going to take place. Maybe some of the long players were counting on boots on the ground, but they had a lot of money bet on the oil price going much higher than it did and staying higher for longer. Today, it looks like maybe there is some form of a resolution that causes the war to be at least at a stalemate, minimal military action between any of the parties involved, and thus you have at least a known factor of a military front relative to the Strait of Hormuz opening up. Even if they had an agreement today, it doesn't satisfy the fact that the Strait of Hormuz is dangerous, it has mines, and it may take 3 to 6 months to clear that. But at least from a trading standpoint, the traders can say, we know in 3, 4, 6 months down the road, oil price will be more stable as we see a continuation or a normalized flow of crude oil coming out of the Middle East. Now, I would like to say that today is probably more of a trading reality than it is a physical barrel reality. Again, I'm not an expert at trading. I'm just a guy who's been doing this for 41 years. What I see today is a little bit of relief in the supply side, meaning there's supply coming from different resources. But I'm here to tell you, those that are in the business are recognizing that supply side is nothing more than like pulling money out of your safety deposit box and saying, I have enough income or I've had a pay raise. Do you really have enough supply, or did you take out a supply you produced several years ago and you're pulling it out in order to balance the market with a short-term expectation and a hope and prayer that true supply comes back and meets that day-to-day demand? Functionally, I think we have a mess. I think we have a hornet's nest. And I don't believe for a minute that Iran is going to give in or back up or agree to anything between now and the midterms. After the midterms, I believe they will have a better assessment if there's truly a support and backing of President Trump's policies and the effort in the war in the Middle East, or if the midterms send out a resounding message saying we're not happy about the economy, we're not happy about your Iranian war, we're not happy about where the country is going today. And if he loses the midterms in the House or the Senate, that's going to empower the Iranian regime to say all we have to do is outlast his presidency. That means chaos for the next 24 to 36 months. I would say you probably have built in a $20 to $30 a barrel geopolitical risk over the next 30 months. Somewhere north of $75 a barrel, up to about $105 a barrel. That geopolitical risk will vacillate week to week, drone by drone, missile by missile, agreement by agreement, deadline by deadline that's never made. Don't know what that looks like. I don't have that information. I'm not in a position to know, nor would I have any guess what they're thinking in the White House. What I know today is you and I as consumers are looking at much higher prices for longer. We're looking at higher inflation, higher demand for energy, less supply of energy, and a global thirst for oil and gas like we've never seen before as a result of the supply shortage coming out of the Strait of Hormuz and the Iranian war. Food for thought. Where are we going? How long will it last? And how much pain can we endure?